In March 2023, a healthy financial institution holding $200 billion in assets became completely insolvent in just 48 hours. This collapse revealed a specific set of market conditions that can turn the basic math of any modern bank into a liability. To understand how the global economy really operates, like, share, and subscribe to The Explainer. We tend to picture a bank as a secure physical vault. In reality, a bank is a high-performance engine that runs almost entirely on a psychological contract. This flowchart maps out a process known as asset transformation, the core mechanical function of all banking. Notice how a high volume of short-term liquid cash flows into a central hub and gets converted into long-term, illiquid investments like business loans and mortgages. While this logic, specifically described by the Diamond Divepig model, fuels global economic growth, it possesses a structural vulnerability regarding timing. The math creates a distinct risk. If all depositors demand their liquid cash back at the exact same moment, the bank physically cannot pay them because those funds are locked into years-long assets. The only barrier preventing an immediate mathematical collapse is confidence, the collective belief among depositors that they do not need to withdraw their money today. Silicon Valley Bank serves as the prime modern case study for what happens when that confidence breaks. SVB had invested heavily in long-term government bonds. When interest rates rose quickly in 2022, the bank suffered from interest rate risk, and the value of those older, low-rate bonds dropped sharply. To fix the hole in their balance sheet, SVB sold those investments at a $1.8 billion loss to raise fresh capital. Instead of explaining the context behind this loss, SVB released a jargon-heavy statement and hosted a virtual call that appeared poorly prepared. That failure of corporate storytelling created a vacuum of information. Viral rumors of insolvency spread through group chats, creating the panic that became a self-fulfilling prophecy. Customers responded by withdrawing $42 billion using their smartphones in a matter of hours, executing an incredibly fast digital bank run. Look at this dense crowd of people blocking the street outside the American Union Bank in the 1930s. In historical bank runs, the slow friction of a physical line bought bank managers time to react. Today, to pay a flood of digital withdrawals, a bank is forced into fire sales, dumping its remaining assets at steep discounts to raise cash instantly. Taking those massive losses on fire sales is the exact mathematical trigger that tips a bank over the edge, turning a lack of cash into total insolvency. And panic rarely stays isolated. Fear destroys confidence in other healthy institutions that share similar risk profiles, creating a contagion. To survive this contagion, healthy banks hoard cash, recall existing loans, and halt new lending. Bank runs interrupt production and destroy the productive investment the broader economy relies on, causing economic damage that hits every sector. When confidence vanishes, government regulators seize the bank, and central banks provide liquidity as lenders of last resort. The first major regulatory firewall against contagion is deposit insurance, managed by entities like the FDIC. This insurance mathematically short-circuits the panic. When the government guarantees your funds, the incentive to participate in a bank run is eliminated. The second major firewall targets the banks themselves, the Basel III Liquidity Coverage Ratio, or LCR. This diagram illustrates the LCR mandate. It forces banks to hold a strict reserve of high-quality liquid assets, cash and bonds, to balance against projected cash outflows. This buffer ensures the bank can survive a simulated 30-day stress scenario. The liquid asset pool is designed to cover a 1-month cash flow gap, buying regulators time to intervene or arrange an orderly sale. These two mechanisms work together. Deposit insurance protects the psychology of the public, while the LCR protects the mathematical liquidity of the institution. Despite the speed of modern digital runs, catastrophic bank failures remain rare because these safety nets allow the system to absorb significant shocks. As an individual, the most effective step you can take is to understand your local deposit insurance limits and diversify large cash balances across multiple institutions. Financial stability relies on a constant coordination between informed customers, responsible management, and decisive regulators to maintain the public confidence the entire system depends on. Thanks for watching. Be sure to like, share, and subscribe to support future videos from The Explainer.